Welcome to the Agent Upgrade Podcast with your hosts Jasmine Cronetten and Alan Corey, where we learn the strategies of top producing real estate agents so you have the tools to upgrade your own real estate career.
All right, it's my favorite time of the week, another episode of the Agent Upgrade Podcast with Alan and Jasmine. Good to see you, Jasmine.
Lovely to see you as always, Alan.
So I almost just want to jump right into the show. Let's bring our guest in because this is going to be this is something every agent should definitely listen to multiple times. Logan Mohtashami is lead analyst for HousingWire. If you like data and graphs and charts and economics of real estate, all the predictions and the financial models and stuff, which, a lot of our sales guys are just like, we're not that detail oriented, but we're lacking, and maybe some of the, at least I'm speaking about myself. Okay. So this is a good balance of like real concrete data. And I'm just excited that he was able to do our show. So Logan, thanks for joining us.
It is great to be here. Thank you for having me.
Nice to have you.
Yeah. So you're what do you call yourself? What's your job?
Lead analyst for HousingWire now. I was actually in the mortgage industry for 24 years. I retired in 2020. In 2010, I created my own financial blog, and one thing led to another. And by 2015, I decided to not just talk about housing, but just talk about economics in general. So I pretty much became not a nerd, but a super nerd at that point. And now all I get to do is look at charts all day and night. So I'm in my own kingdom of heaven right now.
Yeah, well, you're the go-to guy for Bloomberg Financial and like I feel like I see your quotes and your predictions throughout media. So you're doing a good job in retirement.
I work
make
more
a good retired person.
Yeah, work more in retirement. Yeah. Okay, so let's start with everyone wants to hear, and you quite often say that we're not in the housing market, and you've been saying this for housing crisis, I guess. Is that what your word?
A housing bubble. I think that a lot of my work is try to like get people to get off the 2008 housing market. And by the way, housing did not peak in 2008. Housing peaked in 2005. Everybody that says it's 2008 all over again, they're actually not talking about housing. There was all these other things that happened before then. But generally, my work, I always say, if economics is done right, it should be terribly boring. And you kind of always want to be the detective, not the troll. In this day and age, boring doesn't really sell, but I can do my own thing. So my job is to try to relay information on what is actually happening in the housing market. And for many years, in the previous expansion, I always talked about, housing was going to have its weakest recovery ever from 2008 to 2019. And that doesn't mean prices. That's, mortgage demand, new home sales, housing starts. These things are really based off of demographics. So your household formation has to work itself up until years 2020 to 2024. So for many years, I said that period of time will be different. And then all of a sudden, here comes 2020, and housing authentically broke out actually in February of 2020, right before COVID hit us. Mm-hmm. But we got that data in March, and everyone was doing other things kind of the middle of March. We're dealing with COVID. So naturally for me, even though you have to deal with a health and world crisis, you have to create models for that type of event. For HousingWire on April 7th, I wrote a recovery model for 2020, which people thought was crazy. They almost didn't even publish it because they thought it was crazy. Give housing a little bit of time, give it 6 to 7 weeks. By May 18th, things should stabilize. By June data, we should see we're back to normal. And you want to keep it simple. Economics is demographics. Millions of people buy homes each year. It's really affordability, demographics, what happens, credit getting tighter, stuff like that. So years 2020 to 2024 has the best housing demographic patch ever. You put move up buyers, move down buyers, cash buyers, investors, you put them all together. Total home sales, new and existing, should be about 6.2 million or higher. So we had that in 2020. We had that in 2021. There is just one problem with years 2020 to 2024, and it's inventory. We had plenty of inventory to keep home sales going without home prices escalating, but inventory was slowly falling every single year in 2014, 15, 16, 17. Even in 2018, when rates got to 5%, total inventory didn't grow. In fact, the last time total inventory grew was in 2014. So here's the biggest housing demographic patch ever, lowest mortgage rates. There is a risk of total inventory breaking under 1.52 million. The reason I use that 1.52 million is that if you look at the NAR data going back to 1982, when I was 7 years old, traditionally inventory levels are between 2 to 2.5 million. Before COVID hit, we were kind of between 1.52 to 1.93, the 4-decade lows, but still a functioning market. We slammed through that in 2020. There was no seasonality inventory increases. The chaos of COVID basically overrided everything. So 2020 was gone. But what happens is inventory is very seasonal. It fades in the fall and winter, which means 2021, we were starting at all-time lows. So everybody was worried about forbearance crashing the market, even though demand was stable, which was a very interesting premise. Home prices grew 20% last year. October of last year, people were, saying, okay, housing is crashing because home prices got up too much. Inventory fell again. We started 2022 at all-time lows. Now, for me personally, I have an affordability index model and something tied to this period of time. If home prices just only grew 23% in 5 years, we'd be okay. And I kept on talking about that because not in the previous expansion, we really didn't have to worry about price escalation. Here we did. We smashed it in 2 years. So going back to the summer of 2020 for my work, it said, if the 10-year yield gets over 1.94%, which really means mortgage rates above 4%, housing will get an affordability hit. So the two things that would, impact demand noticeably enough collided right in March. And that was kind of when the Russian invasion happened, inflation, bond yields, mortgage rates all took off. So housing is sticky. Higher rates do work. It takes time. I always talk about early in the year that we needed higher rates. It was kind of the thing in January. I said, I'm part of team higher rates because home prices could escalate again this year. And a great example that I use now is if you look at June housing data in Las Vegas sales were down 24% year over year. Their prices were up 21% year over year still. That's not normal. That is what I call a savagely unhealthy housing market. And that's always the concern because housing doesn't move like the stock market. The stock market goes up and down. You could sell your stock like this. It doesn't matter. Housing is one of these things where the seller traditionally, primary resident owners, 75 to 82% of them are buyers of homes. So a seller needs to obtain another house. So when they sell, they buy another home, the inventory channel stays in line. It's really difficult for inventory to skyrocket unless you have forced selling. Forced selling was the 2006 to 2011 market, forced credit selling. And one of the things I try to stress is that the housing crisis really started from 2002 to 2005, where we had a credit boom. 2005, 6, 7, and 8. This is before the recession happened. People were filing for foreclosures, bankruptcies. Then the job loss recession happened. So you had this escalation in inventory because people were forced to sell their homes. None of that was happening in the last 10 to 11 years, right? Credit was fine. Foreclosure data and bankruptcy data were falling. So we got in a really bad spot on the housing inflation story. And it's kind of very hard to solve quickly. So I've always said we need higher rates to get inventory back to 2019 levels, 1.52 to 1.93 million. Once that happens, the housing market is back to its stable self, and I could take the savagely unhealthy housing market theme. So the shock is rates have gone up so fast that people are just reacting like they traditionally do. And a lot of my work in the past is to show people that when rates rise, sales trends fall. Happens all the time. Happened in 2013, 14, happened in 2018 and 19. But typically when rates fall back down, it stabilizes the market. Home prices grew so much, so fast, and even this year, we still have double-digit home price growth that we have to pay the price for all this home price growth and then having the rates go up. So housing should slow. it's going to be slower than what the stock market is. And now we're finally get to see it now that we're in June, July, August data. It looks perfectly actually normal to me, considering how much prices grew and how fast rates rose.
That's fascinating. I think what's interesting is that most people don't understand that we have to raise the interest rates in order to cool off the demand. And then there is a lot of people that are saying, well, interest rates are going to keep going up until the demand slows down, right? Which is the idea. But so is the idea then that when we get to a place where things grind to a halt, then we're going to use the interest rates to.
Well, here's the interesting aspect. When you look at mortgage rates from 1975 to 2022, they kind of move in line with the 10-year yield. Mm-hmm. I personally believe rates have kind of peaked out. They've actually accelerated higher than normal because the mortgage-backed security market is a little bit stressed. But for rates to really go above 6.5% or more, you really need the economy to start growing faster again. I've got recession models. I got models all over the place. So my six flag recession model that I've used, 5 of the 6 recession flags are already up. So it's pretty late in this expansion to have growth accelerate again. So I think that 6.25%, 6.5% mortgage rate was kind of the peak right there, unless economic growth really takes off, or the Federal Reserve and everybody decides, well, because of the oil shortages, we're going to have to like really put the economy into a deep recession, which I don't think the Federal Reserve will do. But this kind of explains why rates have started to go down a little bit. Pricing got really aggressive, well ahead of the Fed rate hikes. The Fed rate hikes are actually trying to catch up to the market pricing. So there's a lot of drama that's going on in 2020, just like every drama is going in 2020 and 2021. Like it's nothing is normal and easy. So trying to explain why rates are falling, why the bond market yields are falling is, traditionally speaking, rates and bond yields fall going into a recession, and they typically go lower during a recession. So right now we have this unbelievable tug of war in the mortgage rate and bond land between the economy slowing down and energy prices are still rising. Now they're falling recently. So should the 10-year yield fall down? Yes, and it has. Commodity prices, copper is falling. So there's all these elements that talk about the economy really slowing and possibly getting into a recession. So bond yields probably the next big move, unless we keep growing faster and inflation takes off another leg higher. Mortgage rates should be down or heading lower. The question is, how much is the stabilizer impact? Now, in fact, when I give quotes to the media in the last 3 or 4 months, I always say my biggest fear is actually mortgage rates have peaked and they come back down, and all of a sudden the inventory we have created starts to slow down or goes back down again. We need to get off of these extreme low inventory, because we could all see what's happening. The market can't function properly with total inventory below 1.52 million. It can when we get toward 2019 levels. We see that in Boise, we see that in Austin, we see that in Phoenix. This is called balance, right? This wasn't a credit boom. This was too many people chasing too few homes, because literally we cracked to all-time lows in inventory. So I always say it's like the hungry hippo game of the 1980s, where you just, smack that hippo and everybody's trying to get those balls. There's not a lot of balls out there. So it might seem like there's a sales boom, but there really isn't. We had more sales during the housing bubble years, a lot more inventory back then, and less price growth. Here, we have less sales, much lower inventory, but much hotter home price growth than we did during the housing bubble years. And that's the frustrating aspect of this period. Is like the worst case scenario, I thought, would be that inventory cracks lower and it's just very hard to get up. And we just simply have to deal with all this price inflation. I mean, realistically, it's like 40 to 45% home price growth in a 2.5-year period, right? If you look back in the previous expansion, none of that was happening before. There's one difference. Inventory broke to all-time lows. The demographics were here. So it was a perfect storm for unhealthy home price growth and rent inflation. So rates, the next big move, I would probably have to say, is down, unless the economy picks up again and let's say the Russian situation becomes much worse, and China invades Taiwan, and there's more shortages, and the Federal Reserve believes that we have to do even more than what we're doing now. So it's a very fascinating aspect of what's going on right now, because a lot of this stuff is under no one's control at this point. But to me, the most healthiest aspect for housing in 2022, staying consistent with my work earlier this year, is that rates went up and inventory is coming up, and we're starting to create balance. Because what happened at the end of 2020 and 2021 and the early part of 2022, and even to a degree the first few months, not a good thing. You don't want shelter price escalation due to forced bidding. It's never a good thing. We see that in the rent inflation as well. Rent inflation took off. So rental vacancies were falling as well. That was another thing. It was actually harder for me to convince people rents were about to take off than home prices, because everybody was leaving the cities. Nobody was going to live anywhere. And no, I mean, it's just supply and demand. We have a lot of people in this very unique once in a lifetime period. So the risk was inflation taking off, not a deflationary event.
So how, besides cooling, or I guess increasing supply, what are options to increase supply besides raising interest rates? And
that's really it. That's the unfortunate aspect.
Okay.
It's the only card we have.
I mean, I'll give you a great example. In February of 2021, at the start of the year, I was going on Bloomberg and telling everyone needs to worry about home prices escalating, and people were still stuck on the forbearance crash bros. Forbearance crash bros is a term I created for people in the summer of 2020, because these professional grifters were running around online telling people housing was going to crash because of forbearance. No, they don't have credit profile risk training, so you could see that they were using models based on 2002 to 2005 for this period of time. Not going to work. But in February, I talked about we really do need higher rates to cool down housing. So the pushback I get, well, if you can't do that, the economy is still recovering. And okay, that's fair. That's fine. I'll accept that. But if home prices take off, it's really the only thing left. Housing construction doesn't really provide the inventory that people think. We've been building a lot more homes lately, and inventory has been falling. Housing tenure has created people to stay in their homes longer. From 1985 to 2007, people stayed in their homes 5 to 7 years. From 2008 to 2022, it's been 11 and 13 years. Parts of the US are 15, 18 years. I've stayed in my house for 18 years. So naturally, inventory is falling. People are doing really well. People love their homes. They spend a lot of money on their homes. We have TV shows on how to spend money on your home. So it's hard for inventory to really break out unless you get demand weakness. So really, there was no other way. There was literally no other way until rates had to rise. And because home price growth was so strong, I truly believe that we should be able to get to 2019 national inventory levels by next year. Parts of the U.S. right now are already cracking the lower levels of that. And that's just balance. It's not a housing crash. It's not forced selling. It's just the function of supply and demand. Now that affordability has taken a really big hit. I mean, with the biggest affordability hit of our lifetimes, because we had such an increase in rates, such an increase in home prices. You put them together, the marginal home buyer always gets knocked out, but now it's also more difficult for move-up buyers as well. So problem with that as well is that keeps inventory at bay. Higher rates also prevent renters from becoming homeowners, so that keeps them as renters. So we don't really have a functioning, fluid inventory situation unless demand gets hit. So that's the unfortunate reality we are in. That's why I was early on this year. I said, that's it. I'm done. It has to be team higher rates. I wrote about it early. I said, global yields are rising, so we need balance, and I'm keep pushing that until we get to 2019 inventory levels. And that to me will be a positive, because then people will have choices. Like, why people hate buying homes in this environment. The confidence index to buy a home is at all-time lows because nobody likes competition. Nobody wants to bid against 10 or 15 other people. It wasn't like a credit boom. It's just literally there wasn't enough product. And this is the function of trying to create balance, and higher rates to me were the only thing that matters. And what's happening right now is that the builders are getting hit and they're kind of slowing production. They did the same thing in 2018. So you're not going to get too much help from construction. It really has to come from weakness in demand and days on market growing. That's the thing. before COVID, days on market were like 30 days. We were running at teenager prints. That's never a good thing when we're teenager prints for days on market. That means homes are selling too fast. And it isn't because sales are booming like we saw in 2004 or 5. It's just not enough homes on the product. Too many people chasing too few homes. We have to find a balance. The only way was higher rates.
And so you mentioned how people are staying in their homes longer, and you dubbed this the silver tsunami that never came.
The silver tsunami was a very, very clever professional grifting marketing tactic that would happen in a previous decade. So the notion of the silver tsunami was, for some reason, around 2015, all the baby boomers were going to sell their homes at once. And they were going to sell their homes to millennials who couldn't buy their homes. So there had to be a 50, 60, 70 price reduction on prices just to match them. I mean, we have to realize post-2008, the professional grifting of housing is a very effective business model. I mean, these are just the biggest doom and gloomers because that's how you address it, right? That's why I always say you want to be the detective, not the troll. So that silver tsunami did not happen. The exact opposite happened. Boomers stayed in their homes because they love their homes. They'll stay into them till they'll probably die. Inventory's been falling. Millennials were the biggest buyers of homes for the last few years. They grow into that age. You know, they're the biggest housing demographic patch ever. Ages 28 to 34, it's 32.5 million of them. People make money. They get married. You know, actually, there's a skit I used to do for the last 8 years. I go to conferences. I say, don't worry. People are very predictable. They rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. Housing is a 2020 to 24 story because so many people are ages 30 to 39. People get married at 28, 29. So everything kind of looks normal. It's just the inventory kept on falling. And unfortunately, we paid the price for that. And there was really kind of no way to stop this. And then the rental inflation took off. So we're talking about a historical event in 2020 to 2022. The housing inflation story on both ends, rents and home prices, is historic. And I don't think I'll ever see something like this ever again in our lifetime.
Wow. That seems like a solution would be like almost from a top-down government level, like requiring higher density zoning or allowing you to build ADU units or turning single-family homes into duplexes. Would that move the needle?
Here's the thing with zoning and everything else. I've written about this a lot. I actually don't fundamentally believe mature economies have, construction booms. Population growth is slowing, so eventually the baby boomers will die. They're going to leave their homes off to people. The problem with just building is that, unfortunately, Americans who make money love single-family homes. So the zoning group or the Yes in My Backyard people are really talking about renters, right? So I remember in 2016, people said, we're building too many apartments. No, we didn't, Mm-hmm. So it's difficult because the builders really push single-family homes. They've been really building multifamily lately. And people with money buy single-family homes. They don't live in condos or apartments, especially when they create families. So the zoning and everything in that regards, I think will help renters a lot, but simply too many people are living in their homes for a very long period of time. And people go, well, what about investors? Imagine if the investors didn't buy all those properties post 2008. Rental inflation would be much worse, right? So we just simply didn't have enough product out there on both ends. And you can't pit renters versus homeowners. That just isn't going to work. So somehow you just need people to keep on building more and more. And the problem I've always had with that is that the business cycles typically prevent that from happening. When rates rise, the builder stocks go down, they pause, and then we just keep on doing this over and over again until eventually where we have so much supply that it doesn't really matter what rates do. We're not in that category yet. And we just got caught in a very bad spot. People think that, and this is where my economic work is really different than maybe other housing economists. People say we didn't build enough in the previous expansion. And I disagree with that for this one premise. We had the weakest new home sales recovery ever recorded in history. Builders only build what they can sell. They don't care about the existing home sales market. That's their competition, right? They're not going to oversupply a marketplace. It'll destroy their margins. So we had missed home sales in 2013, 14, and 15. And then in 2018, rates got to 5%. The builders had a supply spike. Their stocks were down 30%. One of the builder CEOs said, "Oh my God, it's the worst fourth quarter since the great financial crisis." They could get the drama really quick. And here we are again right now. Rates are higher. The builders are now starting to pause. In fact, in March of this year, I wrote for HousingWire, there's your 1.94% new home sales are at risk. And builders' confidence from that point started to go down and down and down. And now they're looking for more incentives. They're looking for pausing. Of course, housing construction took forever. Like, we have 7.7 months of supply for new homes. 6 months of that is just under construction now. Only 0.68 months of that are actually finished product. So then on top of everything else, we have shortages and things took forever. So I just don't think the builders will ever build to the point where people will be happy with it. Unless the government basically says, okay, we'll pay anyone to build as much homes as possible. That probably won't pass. So we're just in this situation to where we just need weakness in demand to create inventory. And hopefully we can get some balance by 2019. Hopefully by next year, inventory gets back to 2019 levels and people have choices and we'll just take the market in that manner. But what won't happen is forced selling. The notion that I remember toward the end of last year, if rates get to 4%, everybody's going to rush and sell their homes to be homeless or rent at a higher cost. That's stock trading. You have to be careful of listening to stock traders, right? Especially middle-aged men who are stock traders who can't hold a relationship. They just don't think, could you imagine like telling your wife or your husband or your kids, oh, by the way, we're going to sell and we're going to move. Why? We have to get out before everything crashes. No, that's how stock traders think. Homeowners, they're just sitting there with a very low payment. I'm good, right? I'm still working.
Yeah, especially some of the people that have their homes locked at 2.5%. I wonder that's going to probably extend the 11 to 13 years to maybe 15 years.
Yeah, here's the interesting aspect. When we look at mortgage rate locks, 13% of the country have rates between 3% and under, or 3% under. 38.2% have between rates between 3 to 4%. 29% have rates between 4 to 5%. So this was the end of last year. So of course now all the new buyers are 5% mortgages currently. So the people that have 5% or more mortgages are people that have very old loans that are small. So the rate lockdown is an interesting premise. The counter I do to that is that there's always a natural listings every single year. It doesn't matter where rates are. There's people that have to list.
They have to move for whatever reason. Yeah.
And traditionally when they list, they know where rates are. So they're going to buy another property. So obviously they can buy. What higher rates can do, especially right now currently, is that some people just can't afford to buy. So the move up buyer, or let's say the move down buyer, somebody to that nature just goes, hey, listen, I can't move until rates come back down. So that takes demand. And this kind of explains why total inventory in America is still below 2019 levels. It's rising, but it's rising from the very low level. Nowhere close to 2012 or 2014 or 2016. Historically, again, taking the NAR data, it's about 2 to 2.5 million. We're going to be, the next report, we're going to be a little bit above 1.3 million. So we're just working our way back. And I see that as the best outcome. Just because what I saw at the end of 2020, 2021, and the early part of 2022, that was not a functioning housing market. We have to get back to some kind of sanity so people have choices. And the one concern I had early this year was that you saw seller stress for the first time in January and February, which means that people weren't even sure that if they sold their homes, they could buy another one because there was such low inventory and there was so much competition. So higher rates solves a lot of this issue, and balance is a good thing. Trust me, I know the implications, what higher rates can do. People are getting laid off. the builders are going to pause, but I'm only talking about it on the economic front of the existing home sales market. That was a hot mess since the end of 2020. And you just cannot have 15 to 20% home price growth every single year just because people are forced to bid. Where the housing bubble crisis, we're forced to sell, we're forced to bid here. So it's a different type of crisis. And unfortunately, that's the reality of the world we're in.
I have a question because I feel like I have a lot of clients that are pre-approved, and what I'm hearing more and more, people are saying like, well, we're just going to wait for the rates to come down. We're going to wait and see if we go into a recession. What would be your words of advice, especially to our listeners who are mostly real estate agents? How do they talk their clients through that type of thinking where, we're just going to sit here in fear and hope that everything crashes?
So we're probably going to have 5.7 million total home sales this year. That's a lot more than some of the years we had in the previous expansion. Housing is the cost of shelter to your own capacity to own a debt. When people are ready, they buy. There are marginal home buyers that aren't ready yet. The rate's too high. I don't know if you could convince them, because I just don't think they make enough money. I think they're waiting. The recessionary holders, I've for many years, I've talked to people that say, I'm just going to wait for housing to crash. Authentically, I don't believe they're like full legit buyers yet. There's nothing in the data that actually shows there's a mass amount of Americans who actually are waiting for something to happen, because every year, millions and millions of people buy homes. When rates rise, the demand trend slows down. So the affordability of that house is really what's driving them. So there's only so much you can do, except when rates fall down. It actually happens every time. After rates went up in 2013-14, when rates started to come down, the market started to come back again. Same thing happened in 2018. Rates went up, market slowed down. Rates went down, market came back again. So they'll know when they're ready, because it's just you're just buying a payment. And with the price gains that we've seen in the rates, it does not shock me that people are like, wait a second, and with everything that's happened right now, if you're talking about a recession, what recessionary data would do is it brings bond yields and mortgage rates down. So people have buying power. That's what happened in COVID. Some people cancel their transactions and say, I'm just going to wait for home prices to go down 30, 40%. They weren't ready to buy anyway. People literally just went back to buying homes after 6 weeks of COVID during a global pandemic, right? Because what people forget is that even though there was 20 to 30 million people unemployed and there was 5 billion of forbearance, 133 million people were working and rates were low. They're just buying a house. So it's just the cost of shelter. That's really it. If somebody is thinking that, well, I'm going to wait until home price, I'm not sure if they're ready yet to buy a house. And there's nothing wrong with that. That's just the affordability index, because you're buying a fixed payment and you believe that you'll be employed, right? So what's the benefit of a homeowner over the years? They have a fixed debt cost and their wages rise every year. So the homeowner has done really well since 2010, so they've stayed in their homes longer. They bought a home. Their payment is fixed. Their wages rise every year. And then we've had 3 refinancing waves, 2012, 2016, and 2020 to 2021. So their cash flow looks great. The home buyer now in this segment is dealing with the biggest affordability hit of their lifetime. So naturally, they should pause. They should be mindful of it. But traditionally speaking, when homeowners are ready, they're ready, right? They're ready to go because they're just looking at the payment costs. I don't believe in we're gonna wait for prices to crash or anything. There's just nothing in the data that shows that there's all these Americans that think like that. I think it's a nice marketing thing, but in scale, people buy homes every year. If rates, let's just say, fell 1% from now toward the end of the year, you'll probably get a little bit of growth in the demand curve, because those people are ready. They're buying that payment. So I'm not a big subscriber to the kind of that people are waiting for crashes to happen. I believe they're waiting because affordability really impacts them. and it's shelter costs. So you just look at that. Are you ready to pay this much for a cost? Or maybe they're not confident in their job, right? So obviously you need to have that a job to even qualify. So I just think the shock of prices and rates naturally have gotten people to pause, which would be traditionally normal with the other times in the last 11 years when rates rose, sales trends falls. We see that again this year. In fact, I would argue, and this is just for myself, purchase application data of the Mortgage Banking Association actually has not fallen as much as I thought it would. And I think what has occurred is that the growth in ARM loans has mitigated the damage of the higher 30-year fixed rate. And that's prevented that index from falling as much as I thought it would. So you're seeing other people trying to find ways to just get that payment in that house. And now that there's more inventory, again, people will have choices. I was very blunt about this. I always say that home sellers and builders had way too much pricing power. So the only thing that will put them on their ass is higher rates. So we needed higher rates to get some sanity in the market, or else they're just going to keep on pushing. Because guess what? A builder and a home seller is going to do everything they can for their own interest. They're not here for the stability of the housing economic cycle for many decades to come. They're here to make as much money as possible. So the only way to check that is through higher rates. So that's why people say, "Why are you so happy?" I said, "Well, balance is finally happening." What kept me up at night was all that price growth. So here, it's just a function of a crazy bullwhip economy, housing market, everything. I mean, everything moved so fast during COVID because of shortages that pricing just got pretty insane out there.
What are the predictions for this year? How much are homes gonna be appreciating?
Well, right now we're still showing double-digit home price gain, and that's the savagely unhealthy part. What's finally occurring is that inventory in certain areas of the US are getting back up to 2019 levels, and the growth rate of pricing is falling. So it seems weird, even for my Wall Street friends, like, how's the Case-Shiller index up 20% year over year? Well, Case-Shiller index lags a few months, but still, you can see what's happened. We're just moving from the all-time lows, and we're creating balance. So home prices still look like they're going to be positive this year, but the growth rate should be slowing toward the second half because rates take a little bit time to work themselves up, and you're working from such a high level that growth rate and pricing should fall. Now, for me personally, I need prices to fall 12 to 18% to make my model work, but I don't ever use that as an exact. I always tell people, if you're talking about national home prices, let's let inventory just get back to 2019 levels, and then 4 months of supply plus. We're at 2.6 months per the last report. We're not back to 2019 levels of inventory in the national data. When that happens, then pricing will be a little bit more interesting. So we're not there yet. And if you look at historical data going back to 1996, traditionally you would need 6 months more supply for prices to come down. I would argue let's just wait to get to 2019 levels and then 4 months plus of supply.
So I'm a real estate investor. It seems like you have this access to this data and these tools that would be like, hey, these certain events, you should purchase a home. And so I'm curious, like, have you ever used your data to invest yourself in real estate?
I even though I'm retired, I am a terrible real estate investor because I bought my real estate investment home and I paid it off, and I have not raised rent on my tenant for 9 years. I didn't collect rent on my tenant during COVID in 2020 and 2021, and it had to be AC. So I've got a $57,000 hit on that. So I'm not that guy. Obviously, there's other ways for me that I've made money, but if you're looking for pricing for real estate investment, just remember the supply and demand trends. When inventory rises, the rate of growth of pricing cools down. So what you saw with like Zillow was purposely losing money because they kept on buying homes at an accelerated rate. And I don't know, their price growth model kept on saying you're going to get higher. So they were the only company that you could possibly lose like $700 million in the highest home price year. So you need to find discounts to what you're paying for. And then when supply increases, no, it just gets harder and harder. And that's why flipping kind of stalled in 2018. It only recently picked up the last 2 years. So real estate investment, of course, a lot of people say, why are there so many real estate investors? The rental yield is still there. So that is a big deal because cash flow, right? Rents are going up, and they go, why are they selling their property? They have so much gains. Their rental income is how they make their money. So home prices rising isn't so much. I do believe part of the putting higher rates is to also not only put home builders and home sellers, but real estate investors. They get a little bit more mindful when rates are rising and inventory rising. That is part of the cooling process of housing because you've got a lot of buyers coming in with inventory low. We need those buyers to reach rates out to get inventory back up higher.
What do you think about, we hear a lot about these hedge funds that are buying up all these houses and buying them for cash. What's your theory on that?
It's one of my favorite subjects because I've got the data on it. We went from 0.4%. These are institutional buyers.
Yes.
2.5%. That's it. Institutional buyers literally just went up 2.1% from the lows in 2020 to what we are now. So iBuyers, in a sense, is total home sales, new and existing, is like 1% of sales. So they're not the big players, but they get, people think like BlackRock or the pension funds are, and they always get labeled as big buyers. I use this example from 2011 to 2017. There was almost 40 million homes bought. They bought 200,000 of them, and they get all the attention, you know. So the smallest buyers ever in history, percentage-wise, got all this attention because it's a good target, right? It's the evil Wall Street people are buying. So, and of course, they're buying heavy in certain areas. But the reason I never liked that narrative is because it made it seem like housing was invincible, that there's no way housing could fade. Housing is always driven by mortgage buyers. Mortgage buyers, when rates rise, mortgage buyers fade, housing fades. When people say that Wall Street's buying all the homes, then you just don't think housing could ever fade because rates wouldn't impact them. They have enough money. So we gone from 0.4% to 2.5%. Some people say, well, investors grew. Yes. And some of the data, investors went from 15% to 20%. Investors in general have been a part of the market for decades. A lot of them are mom and pop shops. 90% of them plus that own investments are, for rental yield mom and pop shops. It's not as big as people make it out to be, but the media loves it. Evil Wall Street, evil institutional buyers, they're buying up all the homes. The peak has been 2.5%. That's it.
I do feel like that the changes that Fannie Mae and Freddie Mac made earlier this year to the loan level pricing adjustments to investment and second homes has really put a lot of interest rate pressure on that segment.
That was their full intention, right? The one way you can slow down a market is by credit tightening. I was so concerned about 2022. If rates didn't rise, I was thinking, my God, we might have to abolish ARMs. Or if rates rose and it wasn't doing anything, we might have to just abolish ARMs for a year just so inventory could get up. But credit controls is something that the government can do. So they took money away from that pricing, and they're trying to put it into more affordable housing products. There's talk about the loan modifications for a 40-year mortgage. Maybe they want to promote a 40-year mortgage. Well, we'll see what that happens. But credit controls is one way to cool down the marketplace. There's only limits to what you could do. Pretty much everything's a 30-year fix. We're all like loan processors for the government, right? We all, either Freddie, Fannie buys them or FHA insures them. So, but you can impact pricing by putting pricing hits out there. And if higher mortgage rates didn't do their thing this year, most likely, I believe that at the end of this year, they probably would have done some more hits on pricing for traditional mortgages. But higher mortgage rates did their thing, so I don't think that's going to be even discussed anymore.
Yeah, and I think that also Fannie Mae continuously keeps rolling out new tightening updates in the underwriting system, the automated underwriting system. It's like, hey, there's an update. It's tightening the credit box. They keep making it a little bit harder.
And one thing about credit tightening, It's a piece that I recently wrote for HousingWire. During the housing bubble years, the credit index availability went from like 400 to 900, right? And then it just collapsed from like 900 to 100. And we can't have credit tighten like that anymore because the products that were facilitating the demand from 2002 to 2005 don't exist.
Mm-hmm.
So there's really not much you can do. So when COVID started, I remember it was March 9th. It was that Monday morning, and I tweeted out mortgage market meltdown. And I was talking about more early payoff risks and margin calls, stuff like that. And people thought that, oh no, here comes, they're all going to go bust. And I said, no, it's not that type of marketplace. So credit tightened from like 185 in that index to 120. That's it. And it didn't mean much. So credit really can't ease, nor can get really tighter. And guess what? Millions and millions of people bought loans. Originations were all-time highs. So there's only so much that can be done on the easing and tightening part. So we can never have like credit getting tighter like we saw from the peak of 2005 to 2008.
Yeah, and I do feel like that's one of the explanations that I have to do over and over again with buyers when they start talking about the housing crash coming. It's like, you don't understand. Those products do not exist. Like you cannot get an 80-20 stated income, stated asset, 580 credit score loan to save your life. It's not going to happen.
There's one chart that I've used over the years, and it really shows people. It's the credit default charts that were, and I draw a nice little line of it, and I show that educated, positive cash flow people don't sell their homes at a foreclosure when they're working to be homeless. It's an interesting concept. I've never seen it happen before, but from 2005, 6, 7, and 8, foreclosures and bankruptcies were rising without a job loss recession. That is abnormal. That means the debt structures of those loans, their shorter durations, were creating foreclosures and bankruptcies on their own. That was 4 years. Then the job loss recession happened in 2008. And none of that was happening in the last 10, 11 years. This was one of the reasons why I coined the phrase forbearance crash bros. Those people were talking about, oh, millions of people are going to flood the market. Everyone's going to foreclose on their homes. Like the nested equity position was like the best ever. And it's just the concept that homeowners are as fragile as these people on YouTube, and they're not. They're just homeowners, and they just work and they sit there and they live their lives. As long as they're employed, it should be good. And that's what the data has shown. So a lot of my work is credit profile risks, and it's to show that, hey, forbearance is going to collapse, right? In the summer of 2020, it's going to be fine. Guess why? Because by October of 2020, most people who make $60,000 and over got their jobs back. And a typical homeowner makes $100,000. So they were not going to foreclose on their home. So forbearance went from near 5 million to under 500,000 now. We're at all-time lows in 30-day delinquencies. So when the job loss recession happens, there are what we call traditional late cycle lending risk. People with low down payments buying into late in the cycle, and then next year they lose their jobs. They don't have enough selling equity. That is going to be like a fraction of what we saw from 2006 to 2011, because traditionally people who work do not want to be homeless when they're employed. It doesn't work that way. It's strange that people think this, or they don't rent at a higher cost. And that's another thing that I was trying to convince people that, hey, rent inflation is taking off. Could you imagine saying, oh, we have a very low fixed payment, but I want to sell my house, not at market bid, but at like a 20, 30% discount to get out to go rent at a higher cost. Your kids would throw every single toy they have at you, right? Because homeowners, it's not, housing is a cost of shelter to your own capacity to own the debt. It's not an investment, right? In that sense. So you have to obtain shelter later. So a job loss recession is a meaningful impact. Late cycle lending is a meaningful impact. Hasn't been the case really in the last 10 or 12 years. And the credit profiles are so extreme. Like you cannot get two different housing markets than what we saw from 2002 to 2008 compared to what we saw from 2014 to 2022. Best loan profiles we'll ever see. And I say this, my family's been in banking since the late 1950s. Best loan profiles we'll ever see in our lifetimes, because people stayed in their homes, they lived them a very long time, they refinance their debt, their cash flow, their wages rise. They're good. And then the nested equity on top of everything else, the amount of equity homeowners have on their things. That's not a traditional foreclosure risk, right? So you're looking at late cycle lending as being the foreclosure risk at that point, which is traditionally normally the case.
I have a
all right. Go ahead.
One more question, real quick, Alan. So what do you make of the Sprout mortgage, the non-QM lender just basically closing up their doors and saying we can't do this anymore?
Real quick. What's for those listening? What's non-QM?
Non-traditional mortgages, basically things that you're not selling to Fannie Mae and Freddie Mac. So those are like the stated income or some bank statement loans or some of the more, out of the box kind of deals.
Qualified mortgage came in 2010. Basically, if you do a loan that's not under that regulation, you have no legal protection, right? So whenever the market gets stressed, guess what happens? Non-QM lenders get hit. Same thing happened during COVID, right? A lot of non-Q overs shut their business down. Right?
Yeah, even jumbo loans went away for a second there.
Yeah. So that traditionally, they're like 4.5 to 6.2% of the lending. So they're not very big. Whenever the market gets stressed, they go out, right? That's that. If they didn't go out, it would be weird for me. Some of them can stay because some of them have a better balance sheets or better investors, but it's not like Countrywide or Washington Mutual or that, because traditionally it's the U.S. government, right? Part of the reason why I thought credit would be very available during COVID is that Freddie and Fannie are not publicly traded companies. Right? They're by the government. They have nothing to worry about. There's no stocks falling and investors saying, oh, you have to take a lot. Credit was flowing. If Freddie and Fannie were publicly traded companies, I might have a different view, but Freddie, Fannie, FHA, VA, they're government. So they can flow the credit, and pretty much everyone else is loan processors for the government. The big commercial banks hold some of their papers in, and especially in the jumbo market, but we saw the same thing happen in the first a few months of COVID. The non-QM lenders left the business. Lending still was facilitated. In fact, we had more originations in 2020 and 2021 than in the previous expansion. So not that big of a deal in the bigger picture. Higher rates do create mortgage people to lay off. Why? Because demand is down, right? So there's too much capacity. That is a function of the business cycles. I always say in economic cycles, you want to find where's the overinvestment, where's the overheating demand. Durable goods spending. I use Peloton as my example. Peloton, everybody started buying bikes with an iPad on them. And then COVID went away and everybody realized, oh, there's bikes out there anyway. We don't have to spend $2,000 on a bike. So they overbuilt their bikes, too much supply. They've laid off 20% of their workforce. This is how business cycles and economic cycles work. So the overinvestment to me in the U.S. economics was durable goods spending. Everybody sat home and bought stuff that they usually don't buy. And now we're coming back down to earth, back to normal economic cycles, and people are out doing stuff. So the money that was spent there in a very short amount of time could not sustain that demand. Kind of like the housing bubble, 2002 to 2005 credit bubble. The sales cannot be sustained. Credit got tighter. It didn't matter how low rates were. You couldn't sustain that demand. A different case now. We never really had like the credit sales boom of the 2002 to 2005 period. In fact, I joke with my housing crash friends. Isn't it awkward that mortgage purchase application data is below 2008 right now, and you guys are talking about 2008? It's like we're already underneath there. Where is the 4 to 5 million inventory that I was told would happen when mortgage demand gets to 2008? Because we're already underneath there. So I have fun with them. Some of them are friends of mine.
And so I want to tie this episode up in a bow. But what I'm hearing is if you have a buyer who's interested in buying a house, they have a job that they feel is steady. They get a pre-qualification on a house that has the mortgage payments that are fixed potentially, or at least a 5 or 7 year arm that they're comfortable paying. They should not, or they should go ahead and buy. Is that sort of
millions and millions of people buy homes a year because they're ready. If someone's not ready, they're not ready. Other people are. It's like that's the functionality of housing, especially after 1996. It's really rare in America after 1996 to have under 4 million home sales. So there's millions and millions of people that buy homes every year. We're going to have like still total home sales. Let's just give a number out, 5.7 million total home sales this year. So there are buyers out there. It's just that when rates rise after home price growth that we saw, there are people that can't afford homes anymore. There are cancellation rates for the new home sector because they qualified at 3.25 and rates are near 6. Right. They can't buy the house. So it looks normal in that sense. I just think that when home buyers are ready, they buy. They don't sit and wait. When home buyers are, I can't afford this, they're not ready. And the history of housing data has shown this to be the case, that rates fluctuate sales trends. Credit expansion can fluctuate sales trends, but there isn't really a mass amount of people like sitting back and going, I'm going to wait for home prices to crash. And then when that happens, then I'm going to buy. Or I hear these stories. Oh, my friend sold their house in 2018. He said, I'm going to wait until home prices come down 50%. No, in general, math does not happen. So people just buy a payment, and when you're ready, you're ready. That's why we always say housing is the cost of shelter to your own capacity to own a debt. It's not an investment. It also explains why millions of Americans buy homes each year. That payment is affordable to them, and they own a home, and the benefit. I would argue that homeowners have gained way too much benefit in the last 10 years. The fixed payment, wages rise every year. They've refinanced. And also, I think people have become a little bit more clever that, well, even if I buy now at 6%, rates fall next time, I'll refinance out. And that kind of explains why we're going to have like near 5.7 million total home sales, new and existing combined together. Because when people are ready, they're ready, they buy. Even in the early part of the century, when rates got up to 8%, we still had over 5 million home sales back then. So it's just a payment. It's just a shelter cost. And it's very boring to keep it in that perspective, but that's the truth. And that's why a lot of people bought homes in 2020, even during COVID. People say, you're crazy. Why are you buying a home and home prices are going to crash? Home buyers are ball players, man. They're ready to go. They don't sit there and just like, I panic. They make good money, they buy a house. Nothing else.
I also feel like there's some they need to have optimism about the future. And I feel like every election period, there's definitely a slowdown because I feel like half the country feels uneasy, right? Or both sides feel uneasy because they don't. What direction is the country going?
Well, this is the interesting aspect. Last year, home, the percentage of people that wanted to buy a home or thought it was a good time to buy a home fell to all-time lows, and it was also like 12-year highs in sales. So surveys are tricky in a sense that. So why are people like the Michigan Confidence Index is at the lowest levels ever? So everyone hates everything, but they're buying homes or they're buying cars. Why is that happening? It's just because nobody likes paying more for stuff that they have to buy. That's why, and nobody likes inflation, and nobody likes bidding wars. I mean, God, it was so hard hearing people like, I've lost my 7th house. Young families are like, so that would piss anyone off. This is why I think balance is a good thing. And the only thing that could create balance is higher rates. So let's just get back to 2019 inventory levels, and we'll take it from there. But below 2019 levels, nothing good came out of this. Of course, if you're a homeowner, you're like, oh, great, my home value went up 40%. I'm going to sell my house and put 80% down on some home in some other state. Yeah, good for them. It's like, so it is what it is. It's the unfortunate reality, but this was a slow train work. And a lot of my work on HousingWire, lots of charts and the podcast and everything we do every week, we're trying to explain economics in a boring, easy way for people to understand. So
you do a great job at it. We love it.
Hopefully it's different. And that's why I always say everyone needs one good nerdy friend.
Yeah. You need a doctor, a lawyer, good nerdy friend.
We have our uses.
All right. Well, Logan, thank you so much. How can people follow you? I know you're very prolific
all
online.
my work is licensed through HousingWire. So if people wanted to subscribe to HousingWire to get it, Logan VIP 50 code, you can get a big discount on it. I do podcasts twice a week now. And I do now travel around the country to speak at events. We recently had a cocktails event in New York that was maxed out, and the fire people weren't happy about that. But so just my name, you can find me on Twitter and Instagram. So Logan Mohtashami, and I literally do Instagram stories each day talking about all economic charts. So it's not a very fun Instagram page, but if you wanted to get bored out, I do talk about charts on the story section every day. And it's not just housing, it's all economics, because primarily I work on economic cycles. Housing is a secondary, but we go over everything every single day, one day at a time, because economics never sleeps. It's an ongoing event, and we just take the data and try to make as much sense from it.
Great. And what's the name of your podcast?
It's The Rundown. It's HousingWire Daily. It's they'll be on twice a week, usually on Monday and on Thursdays.
Well, thanks for joining us at Agent Upgrade. Appreciate it. We learned a lot.
Pleasure. Thank you so much for having me.
Thank you. Bye-bye.
Yeah, thanks, Logan. Appreciate it.
Thank you for listening to the Agent Upgrade podcast. If you are an agent looking for a new mortgage lender, start with Jasmine at jasmineteam.com. If you want to learn about real estate investing and working with investors, check in with Alan at thehouseofac.com. See you next time on Agent Upgrade.